Alright, so in this video, we're going to be going over liquidity, levels of liquidity, and liquidity sweeps. Um, to simplify what liquidity is, it's areas on the charts or zones on the charts that are at highs and lows. So let's say, draw this out for you to give you a visual reference. We have this high right here, this low right here, this high up here, and then this low right here, and this high, and then this lower low, and this high, and this low, and this higher high, and low. Liquidity lies at highs and lows. So if we go back to our, oh, put it right to purple. If we go back to our drawing tool and we change our color to white, we have liquidity right here. We have liquidity down here, liquidity up here, liquidity down here, liquidity up here, liquidity down here, liquidity up here, liquidity down here. So liquidity lies at highs and lows of the market. And we can expect price to go back to those highs and lows to fill out the imbalance and to grab liquidity. Um, to show you liquidity on the actual charts, let's get into it. So let's just go to the 15-minute just to make it easier to show you. We have a high, a low, a high, a low, a high, a low, high, low, high, low, high, low, high, low. At this high right here is liquidity. This is liquidity right here, guys. And I always mark my liquidity out as white. This high right here, liquidity. And we see it gets swept right here, right before market close on Friday. Um, liquidity. Liquidity. And we see this low right here, that's also a level of liquidity. And we see this lower low right here, that's also going to be a level of liquidity. And you'll see people mark out liquidity differently. Some people will mark it off of the open and closes of candles. Others will mark it off of the wicks of the candles. I mark it off the wicks just because it gives me more range. Like right here, we have another high. That's going to be liquidity. And what happens? Price goes back to that level because it has to get the liquidity to move further. Right here, another high. Liquidity. Right here, another high. Liquidity. Right here, another high. Liquidity. You're going to hear me say liquidity a lot this video, so get ready for it. Because that's what liquidity is. It's at highs and lows of the market. Like, for example, let's go to Friday, show you how liquidity played out. We have market open at 9:30, right? Yeah, market open at 9:30. We have Asia London session right here. Let's just go on. This will be easier to show you actually. So we have Asia London session right here, right? We have the high of the session and the low of the session, right? We have the high right here. We see price goes down, sweeps out Asia lows during London session. Once it sweeps out those lows during London session, it makes new highs, takes out the Asia highs. And then what happens? We see a close above this level of liquidity indicating a shift in the price action. So let's go to market open right here just to show you how this played out. So we have this low right here and this high up here. This is liquidity down here, right? Liquidity. So I'm not going to be typing out liquidity every single time. I'm going to be marking out liquidity as just the letter L because L stands for liquidity. You'll learn that. Um, you'll see other videos online where they have internal liquidity or just liquidity. They're literally the same things, just at different levels. Like we have this high right here, but this high right here and this high right here are internal levels of liquidity. So with that being said, we see price goes up, sweeps out this low right here, right? Or we can even see prices up here, right? Sweeps out this high, creates a liquidity sweep. That's what that means. Is it's when price sweeps liquidity. It's literally, you can't put it any other way. It's two words. Price is sweeping liquidity, liquidity sweep, right? We see liquidity sweep right there. And then we see a new high made, which makes a new level of liquidity, right? And then we have internal levels right beneath it. Right here at this high, right here at this high, right here at this high, just like that. Price is always going to fill out the imbalance that is occurring by seeking liquidity. Liquidity. Let me see right here. Liquidity gets filled, sweeps it, goes back up, fills out this right here, liquidity, fills out this liquidity, and makes out these new levels of liquidity beneath it, just like that. That's all liquidity is. Liquidity is just highs and lows of the market. Like if we go to the 15-minute, take off this time thing, we see price, it sweeps liquidity and always fills out the imbalance shortly after. Like we have this high right here, right? Gets swept and then targets lower levels of liquidity down here, like that. That's all liquidity is. This is such a easy video to understand. All liquidity is just highs and lows of the market. Like we see price sweeps this level of liquidity right here. What happens after the liquidity sweep? It targets lower levels of liquidity that are going to be lying down right here. Like if we go to the if you go down to the 1 minute, we'll see highs and lows right here, which target out this liquidity. Bang, liquidity at this low right here. Bang, more liquidity at this lower low right here. What is price doing? It's seeking liquidity because it had a sweep above. And what happens when it sweeps this liquidity down here? It creates new levels for new highs. Meaning what? Liquidity lies at these highs up here. That's all liquidity is. It's just highs and lows of the market. There's no other way to put it. Keep it as simple as it can and don't complicate it. That's all liquidity is. It's just highs and lows of the market. Like right here, we have this high made, right? Bang. What happens? You sweep out these lows down here. Because why? Because we need to fill the imbalance. That's where liquidity lies. And what the heck? And what happens is those levels get filled out because it has to fill out the imbalance. I said this, I think, in the first video, and during while I was talking about fair value gaps. If price never filled out imbalances, then we would only ever have one continuous motion of price action, whether it be bearish or bullish. Because without filling out these imbalances, it can't allow for these confluences to occur to let price react off of. Like right here at this low, we have liquidity, and that's why once we went back into this bearish fair value gap right here, price then did what? It went back down to this level of liquidity to fill the imbalance. And what do we have right before this bearish fair value gap? A bearish order block. I went over that in the last video, so I hope you understand what an order block is, because look how it plays out. Price reacts to this order block, right? And every time it goes back into it, it just simply rejects off of it. Like once you start understanding how these confluences work, it's like you can predict where the market moves, and that's why it's like you achieve becoming a future teller. It's as easy as that. No matter how long it takes you to understand it, that's the most important part about trading, is understanding how and what and why everything works the way it does. Like we have this high right here creates liquidity, but we also have this internal liquidity right here at this low that gets swept out. And what happens after it gets swept out? You become bearish again. Like right here, we have this low down here, which gets filled because we have this liquidity sweep. And what happens after the liquidity sweep? We have a bullish fair value gap get formed, which then gets respected, causing it to go to these targets levels of liquidity. Like that's all liquidity is. It's just highs and lows of the market. Like people will make it sound so complicated and make trading sound so impossible, but what makes it impossible is not understanding the right way, or just misconstrued or misinterpreting like what is happening in front of your face as it occurs. Like look at it like this, like we have this high right here, right? Gets filled. We have this low right here, right? Liquidity gets filled. Now we have this high right here, right? Gets filled. What do we have down here? Another low? Who would have thought? It gets filled because price goes down to where liquidity lies. It's as simple as that. It's all liquidity is. It's just highs and lows of the market. And that's why this video isn't going to be too long, because that's all liquidity is. And the reason why we use liquidity is because that's what allows us to set or take profits when we're trading, and set our targets to where we expect price to move to, is because price hunts liquidity. It's as simple as that. Like for example, I'll show you the trade I took on Thursday this week. Give me a second. Clear this stuff off. We'll drop down to Thursday, and I'll show you exactly how I executed it and what I saw. Or even I'll show you first, or even Friday I can show you. Like it's so easy once you understand what is happening. Like this is the trade that occurred on Friday. We have our go back. I use this indicator to show my time zones, and like this is market open and AM session. This red area is Asia London session. I'm probably gonna split this into two colors to indicate which one is which. I just have it as one just because I don't ever trade this session. But as I was saying, let me show you how this would have played out on Friday. So wait for 9:30 to open, right? See price moves, yada yada yada. Price is moving, price is moving. Right, price is moving. Okay, what do we see here? We see price sweeps this high right here, creates a new high right here. And once it sweeps that high again, we can expect price to start reversing because we're sweeping highs and creating new higher lows. And what are we going to do? We're going to target these lows down here because that's where liquidity lies, and that's where we target is liquidity. So we have this low right here, and we have this other low right here, right? And these are both levels of liquidity because they're lows in the market, and that's where liquidity lies. Liquidity lies at lows. So these lows right here is our internal levels of liquidity, right? But as I was saying, now we're looking to see a break of structure, right? So how break of structure works, I don't want to go too far into it because we're talking about liquidity in this video, and I have a break of structure video set planned to go over in depth what a break of structure is. But we see highs and lows forming, right? We need to see a close below this low right here to indicate a break of structure, right? So now we wait. Bang, right here we see this break of structure, right? And we also see within this break of structure a bearish fair value gap forms, given confluence that we're going bearish price action. And what happens? Look at that. It breaks structure. Why? Because it's hunting liquidity right here. Like it's clear as day that we're sweeping out this low right here because that's where liquidity is, and then we also sweep out this low right here because that's also where liquidity is, right? And now what we're going to look for is a retracement back into this area, and we're going to set our stops to the movement that caused this break of structure, to the candle that caused this break of structure, right? So we would set our stops right here, And we can either target a fixed 3R, which would result in, let's see, 34 points. Or we could target liquidity all the way down here because we know price hunts out liquidity, which is going to result in 84 points, right? So we'll let it play out. Price sweeps this low right here. Down here, it sweeps these lows, retraces back into here, right? But we have this bearish fair value gap and this bearish order block right before this, so we can expect price to respect these confluences and continue down. And we see price then fills us right here at this level that it broke structure at, and now we're targeting right here, which is going to be this new low that got formed after it swept the previous level of liquidity. So right here is liquidity, right? It sweeps it, and now it creates this new low right here. This new low where liquidity is lying now, and we just let it play out. What happens? It hits it. Why? Because price seeks out liquidity. And what happens as we see price seek out this liquidity? Bearish fair value gets formed right here. And we can expect price to possibly even sweep out these lower lows. But I'm pretty sure price didn't, because we have this bullish order block right here. So I'm pretty sure it respected this bullish order block if I do recall properly. And I don't think we reach these lower levels of lows, but that's why we have our take profit areas, so we don't get greedy and turn winning trades into losing trades, right? Yeah, that's what I remember happening. So yeah, it's as simple as that, really. And as we see here, let's get rid of all this other stuff. We have, after new levels of liquidity that formed, we have this new high right here, which is liquidity, right? And we have this internal level liquidity right here that gets filled. Why? Because price hunts liquidity. That's all it does. And what happens after it hits this level of liquidity? It makes a new low. And guess what happens? Price sweeps that low again and creates an even lower low. Bang. Liquidity, 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 liquidity. That's all liquidity is. It's just highs and lows in the market. Like, brainwash yourself into understanding that. That's all it is highs and lows in the market. We don't actually have we do have a small daily fair value gap right here. But if we go down to our 1 hour, let's see what we see here. We see a 1 hour bearish fair value gap being respected. What else do we see? We see liquidity right here. We see liquidity up here. And we see price is frozen in this fair value gap right now because market is currently closed since it's Saturday. But honestly, we also have a order block right here with this movement up because we made a lower low after. So I'm honestly bearish. I'm expecting bearish price action on Monday, if I'm being completely transparent. We have another fair value gap right above the other one right here. And then we also have a 4-hour order block right here. If we look at this movement right here, from this candle to that candle, is a 4-hour order block. So with all these bearish confluences rising or weighting above price right now, that's what makes me expect price to be bearish on Monday. Like, look at this, another order block, another order block. But that's me straying away from liquidity. What do we have? Liquidity. Where is that highs and lows? Bang. Liquidity. Liquidity. That's all liquidity is. The key takeaway is that liquidity lies at highs and lows. Why is liquidity important? Because that's what price is drawn towards, is liquidity. And that's really it. That's liquidity, and that's what levels of liquidity are. Is there's just highs and lows. That's all liquidity is. It's just highs and lows in the market. Like, this low right here is liquidity. This high up here is liquidity. What happens after it makes that new high? Who would have thought? Price goes back down to liquidity to fill out that imbalance. Price will always fill out the imbalance. That's what it does. If price didn't fill out the imbalance, we would only ever move one way in the market, and that wouldn't be sustainable. So that's what liquidity is. It's highs and lows in the market. Why is it important? Because price seeks out liquidity, right? We see this low right here. What happens after this movement up and creates these highs up here? It goes back down and seeks out liquidity. It's as simple as that. Like we have this low right here, right? Liquidity. We have this movement up, and then we have this breaker structure right here, creates our movement down. And what happens after this breaker structure right here? It seeks out liquidity. It's as simple as that. So what I want you to do now, after watching this video, is go on your chart, mark out all your confluences, your fair value gaps, your order blocks, your inverse fair value gaps, and now on top of that, mark out levels of liquidity so you can see why price is moving the way it is and where it's going to. The more you do this, the easier it will be for you to understand what is happening in the market and why it's happening. And once you understand that, it's free game. Like you're gonna be making stupid amounts of money. It's ridiculous. And the only thing that would be stopping you, if you're understanding it and not making money, is your discipline sucks. You're not following your trade plans. It's as simple as that. And that's what stopped me from being profitable for so long, was that I wouldn't follow my trade plan, and I thought I would knew exactly what was happening, and I kind of did, but I didn't follow my trade plan. I overtraded, over leveraged, and that caused me to blow funded accounts left and right. Once I really sat down, stuck to my trade plan, stayed disciplined, it was it was it was payouts from there. It's as simple as that. It's payout after payout to payout, and that's why now I copy trade accounts to leverage the knowledge that I've learned, and leverage that knowledge to allow me to make more money. Because once you start copy trading on one account across 5 different accounts, that 2K payout turns into a 10K payout. Like and you can trade up to 20 accounts at once. So that 2K payout now turns into a 40K payout. It's diabolical how trading works, and it's a beautiful thing, really. So really, just learn these confluences, and I mean really learn them, and you will be set. It's as simple as that. That's going to be the video for liquidity. Key takeaways: liquidity lies at highs and lows of the market, and price is drawn to liquidity, right? Like to show you more examples, we have this high get created. It sweeps out this low right here. This previous low, it sweeps that out. And then there's a break of structure right here. Once we see this, once you see this high get closed above by this candle, break of structure. And once you see that break of structure, we can expect price now to seek out these previous levels of liquidity right here. Like, let me show you. It just sweeps out the levels of liquidity, and then what happens after we sweep out this high up here? We create new higher highs. And what happens when we create that new higher high? This new level of liquidity is formed. But what can we expect now that the new higher high is made? We can now expect price to fill out this big imbalance right here. This big imbalance, we can expect price to fill that out by doing what? By seeking liquidity. And where is that? Right here at this low. That's one level. Right here at this low, that's another level. And then right here at this low, which is a third level that doesn't get seeked out, but that's why we have our take profits, so that we can execute where our trades need to be stopped out at and where they need to be taken profit at, is at these levels of liquidity. It's simple. And then what happens after we sweep out this low? Now that we swept out this low, what can we expect? We can expect price now to fill out this big imbalance right here by seeking out higher levels of liquidity up here, like at this high, and at this level right here. All these highs are it's just price seeking out liquidity and filling the imbalance. That's all it is. That's literally all it is. That's all liquidity is. It's highs and lows of the market, and it's important because price seeks out liquidity. That's all liquidity is. It's highs and lows of the market. Why is it important? Because that's where we set our take profits at, our levels of liquidity. and price seeks out liquidity. That's why it's important, because price is always seeking out liquidity, and that's what makes us be able to predict where price is going to be going to after we execute our trade. So that's going to be it. That's going to be it on liquidity. Take notes. Really, really read over your notes. Absorb the knowledge that I'm teaching you. And like I said in the past 4 videos, or 3, I'm not sure which one I'm on now, or what number I'm on now, but go onto your chart and mark out these confluences. Mark them out for at least 30 minutes minimum. Just go and mark out the confluence so that your eyes become like trained to see these without you having to really think about it. Like I can look at this blank chart right here, and I can spot out 10 different levels of liquidity, 5 different fair value gaps, at least 6 different order blocks, and let me see, like 4 different breaks of structures without really even looking at it. Like once you just do this, do it over and over and over again, it trains your eyes to just see this, and it's it becomes easy. After it's hard, it becomes easy, and that's what learning is. It's hard at first, but then it becomes easy after you learn it. So yeah, that's it for levels of liquidity. Key takeaway points: highs and lows in the market, price seeks out liquidity, and our take profits when we're trading are at these levels of liquidity. So hope you enjoyed it. Go study, and then once you're ready, go to the next video.